Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton. I'm the Director of Investor Education here at PassiveInvesting.com. And today with us is our special guest, Jenny Gu. Jenny, welcome to the show.
Thanks so much for having me, Whitney. I'm super excited to be here.
Awesome. Well, Jenny, before we dive into the Ironwood Estates, your 40-unit deal in Phoenix, Arizona, tell us a little bit about yourself and how you got into multifamily investing and where you're at now.
Sure. So I like to say I'm a recovering sales professional. I spent 13 years in corporate America before discovering the wonderful world of real estate. After working there for several years, we decided to start investing in something different. Started with single families, like I'm sure a lot of your listeners start with, then learned about multifamily and just decided that that's where we're going to invest 100% of our time. Fast forward to 2020, quit my job before buying a single unit of multifamily. So did it a little backwards, okay? And then fast forward to now, we have a company, Vertical Street Ventures, and we have about 300 million of multifamily doors under management.
Awesome. We'll talk about a burn the boat scenario, right?
Yes.
Well, let's dive into your deal here. So we're talking about Ironwood Estates, and it's a 40-unit property in Phoenix, Arizona. When did this deal close and how did you find it?
So this is one of our last deals we closed in 2022. This one we closed December 5th, so right at the tail end of Q4. And this is where I like to say, relationships with brokers are so important. So this deal, we actually submitted a bid for, I think 3 months earlier, and we weren't the highest bidder. We didn't get the deal. We were really disappointed because we love the property. And fast forward to, I think it was late in October, early November, they said, hey, the deal fell through. We were one of the first people the brokers called because they knew we were interested. So that's super key to maintain those relationships because you never know when you'll get a phone call back about any property you were looking at before.
Awesome. Okay. So you had the deal, you put in an offer, it didn't get accepted, it comes back around. Were anybody else competing in on this deal, or did you just kind of have the first look and first right of refusal from there?
I think there was one other group in the pocket, but because of our relationship with the broker, he gave us all the information we needed to come back really strong and secure the deal.
So talk to me about how you structured that offer. What did it look like? Like, what were the terms that made it strong and beat out the competition?
Yeah, so we came in at a very strong offer price, right at where they were asking for. But what made us strong, we were still offering hard money at that time. And if you think about where hard money was in Phoenix, particularly versus the rest of the country, hard money was almost an expectation earlier in 2021 going into 2022. By the end of 2022, that has kind of tapered off a little bit, or it wasn't as aggressive. So we actually used that to our advantage and we offered in some hard money, sizable hard money day one to make sure we got the deal.
Okay, so let's talk about what was the purchase price and what was the due diligence timeline, the entire timeline of the purchase sale agreement?
Yeah, so the purchase price was $10.3 million on a 40-unit deal. So it's roughly about 250 and change a door. And it's built in 2002. So it's one of our newest properties that we purchased. Typically, we buy Class B, B minus properties built in the 80s, 90s. But this one was amazing in terms of the vintage. It's one of our newer ones, as I mentioned. So we got a good deal on it, $10.3 million. We raised about 5.6, 5.8 roughly on the raise. Yeah, so that's where that came about. And then in terms of due diligence, we had the typical 30-day due diligence inspection period, which went really smoothly given that it was a newer building. There weren't a ton of deferred maintenance. There wasn't a ton of surprises. So actually that made that whole time frame go much faster.
And so you had money down hard. Was that hard from the very beginning, or did it go hard after inspection?
We had money hard day one. And then after the due diligence timeframe, I believe we put in an additional money.
Okay. And then did you guys fund that yourself, or did you go to your investors to help them fund it?
So this was a true syndication. In fact, what's unique about this deal is the fact that we partner. So we have a mastermind, an academy that teaches other people how to do what we do, because I wish I learned this 15 years ago, 15, 20 years ago. So this is actually one of our student deals where we partner with them, students in the academy, to help get their foot in the door, help them learn from soup to nuts, every aspect of doing a syndication, including the acquisitions timeframe, the due diligence, the capital raise. So we partnered with our students in this deal to raise the capitals through our investors.
Okay. So you purchase sale agreement, you beat out the competition, you have money down hard, 30 days due diligence, another spot of money down hard. How long did you have to close?
We had, after due diligence was complete, I believe we had 45 days afterwards. So it's pretty standard timeframes if you think about all the PSAs out there. You get between 14 to 30 days of inspection, and then typically 30 to 45 days after inspection is complete to close the deal. And then we didn't need any extensions after that, but typically you could see a finance contingency on that as well.
Okay. All right. So your offers has been accepted, and now it's due diligence time. At what point in time did you walk the units of the property?
Really early in the due diligence process, because we want to make sure you have time to fully walk the property. So we walk every single unit, inside, outside, you name it. We walk all of the major electrical, plumbing, we scope all of that. We look at the roof. So all of that happens. And we do that typically within the first week of the due diligence process, so that you have time to get the reports, do any additional due diligence needed, go back to the seller if needed. You never want to wait any longer than a week. It gives you super tight timing to get those reports. And in fact, what we try to do is, before the day ends, before any of the contractors or subcontractors leave, we ask that they come talk to us so that we have an idea ahead of time what they found, so we can crunch any numbers or go find a second opinion if needed, versus waiting the week or sometimes 2 weeks to get their full report.
Were there any surprises that came up during due diligence?
No, not on this property, which we're really thankful for. It's nice that it's newer. So in a 2002 build, there wasn't anything that was crazy that was unexpected. The roofs were still very new and were under warranty. But I think, sometimes you don't always get that, right? Nothing's always perfect. But in this scenario, luckily, nothing out of the ordinary came up for us.
Okay. All right. So, all right, you kind of sailed through due diligence, so to speak here. What was your business plan with this particular property? Were you doing any sort of value add strategy with it?
Yeah, so that's our typical MO. So we do traditionally value add multifamily, which means renovations interior could range between, $7,000 all the way up to $30,000. In this scenario, the units were truly classic in that they looked like they were built in 2002. The previous owner had already renovated 14 units. Okay, so our game plan was to go in and renovate all but 5. And the reason is because the property is coming off of a LURA agreement. So it's low income housing property. And fortunately, it ended in November, right before we closed on the property. But there's a stipulation that we have to maintain 5 of those units have to be low income. Okay, so we're going to renovate all the rest with the exception of those last remaining 5. So that's from an interior standpoint, full renovation. We're spending about between $20,000 and $25,000 for the full upgrade. Stainless steel, new flooring, blinds, cabinetry, you name it. And then we're adding a bunch of amenities because it's a newer property and because of the market rate that we're taking it to. We're adding in a brand new playground, a dog park, a brand new gym, just to name a few, just to spruce it up a bit.
All right. Well, before we move off the due diligence piece, I want to ask questions, right? Because the physical due diligence is only one piece of the puzzle. And it sounds like you didn't have any issues there. Am I safe to assume you didn't have any issues with like the insurance due diligence because you would have already had that all uncovered? How did the financial due diligence go on this property?
That one went well as well. So typically, yes, you have the physical, which passed with flying colors. Then you have the financial diligence and rent roll inspection and all of that stuff. So that's where we work very closely with the property management team to make sure they're double checking leases with the rent roll, making sure that all checked out, which it did. And then we went through the financials again with a fine tooth comb. And you're doing that in concurrent with what the lender is doing as well. So they're doing the same process that you're doing. And fortunately for us, there wasn't any red flags that came out of that either. So that was good news.
Well, I'm just waiting for the other shoe to drop here because I have never heard of a multifamily deal going this smooth. But anyways, okay, let's move on to the financial piece. How did you finance the deal?
So we got a loan. This was our first time working with a bank called KeyBank. And so this is a loan we received, and we had great terms on this one. And so we were able to secure the loan at a rate, including purchasing a cap rate that got us to sub 4%, which is unheard of in the last year, really. And it's a partial recourse loan too, which is really nice because a lot of times bank loans are 100% recourse versus the traditional Freddie, Fannie, or even a bridge loan, which is non-recourse. So that was something that really attracted us to KeyBank as well.
So walk me through, what does it mean to be partial recourse?
So up to 25% of the loan amount will be recourse for us.
Okay. Okay. So you do have some skin in the game here, but not the whole thing. Okay.
Yes, which I had not even realized was a thing until we started working with KeyBank. So that's real. And so it's definitely something we'll look into moving forward in some of our other deals as well.
All right. So talk to me about the rate. What's the interest rate on it? How long is it fixed for? Is there any lockout periods or prepayment penalties?
So the full debt summary looks like this. We got it for about a 65% loan to cost. The interest rate ended up being around 3.65, and we purchased a cap rate that got us just below sub 4%, which is amazing. Terms, it's a 3+1 year term, interest only for 4 years. And believe this, and I know it sounds crazy, but there's no prepayment penalty on this loan. So KeyBank it's the one we're working with now. It's been, gosh, it's February now, so a little over 2 months in, and they've been just wonderful to work with. We're just starting our first CapEx reimbursement draw right now, so hopefully that process goes smoothly. It doesn't always with some of our other lenders, but based on what we can tell, it's going to be a smooth process with them.
All right. Well, let's move on to the raise part, right? So you guys raised money for this. So we already talked about the lending, so 65% debt on the property. So you raised 35% from investor capital and then plus repairs. Is that how you did it?
Plus repairs, yeah. So we raised extra for the renovation. So we wanted to make sure we held some money back of our own versus, this is a good tip for most people. Typically, if you finance the CapEx, the lender will hold that money, and then you'll have to do the whole CapEx reimbursement draw, it takes a long time, it's cumbersome, there's a lot of back and forth. You lose a lot of potential time and out-of-pocket money right before you get reimbursed. So we always try where we can in our underwriting to bake in capital that we raise on our own so that we're holding on to that initial capital and not having to wait for the CapEx reimbursement process.
And so how much did you raise?
So we actually raised closer to 5.8 million. We had to purchase a rate cap, I should flip the words, rate cap, and then raise money for that additional renovation as well.
Okay, so total raise was 5.8. Was that all in, everything together?
All in, yep, closing costs, all of that baked in.
Okay, and so you went to your investor base and did this. How did you structure this for your investor base?
In terms of the returns?
Yeah, pref, returns, or did you have a pref?
Yes, yep, we did. So there in this investment, and we believe we're going to move this model to all deals moving forward, but we have 2 different types of classes for our investors to invest in. Class A is a 10% preferred paid monthly, but no upside. So this is for the investor who doesn't necessarily need or want the upside at the end. Their main primary concern or priority is the cash flow, consistency of cash flow every single month. Okay. And then Class B investors is the other portion of it. So these folks get 8%, paid quarterly, but they also partake in the upside when we sell or refinance. And there's a waterfall that comes with Class B investors. So it's a 70-30 split waterfall, and it becomes 50-50 after a 15% IRR hurdle. So that's pretty standard in the industry as well.
Okay. What kind of fees did you charge on this deal?
So we charge acquisition of 3% on this one. And then from an asset management standpoint, so that's the monthly fee that we charge for just managing the property day to day. So that's 2% off of the gross income of the property every month.
Okay. So there's one other partner in here that I want to kind of, tease apart a little bit, right? So we had the general partners, that split. Then we also had the, split for the limited partners. But you mentioned that you purchased this with one of your students. How did that structure shake out?
Yeah, so we partner with our students, and typically, right now we split the deal 70-30. So in terms of the GP percentage, VSV would get 70% of the deal and the students get 30% of the deal. And that's our way of helping them get into the business. We lead the property in terms of the calls and every single step of the acquisition and capital raise. And they're learning and they're watching. And my goal is eventually in the next 6 months, they take over after watching me manage the property, and I'll still be in the background, making sure things run smoothly, but then they're getting the hands-on experience to take on, and this is their first deal it's a team of students actually, so a few folks, but they're getting the experience hands-on.
Okay, so essentially you're operating the deal and they're getting the hands-on experience, and then eventually you're going to flip the model on them. Okay. All right. Well, were there any surprises that came up in this deal that we didn't touch on?
There weren't a ton of surprises during the acquisitions phase. But again, it's been 2 months in and we've already unfortunately stumbled upon crime on the property. Even though it was a 2002 build, nice neighborhood, we had a theft recently on site that I'm happy to talk about. Somebody broke into the office and stole the box of keys. And so that is huge because those keys obviously go to every single resident's doors. And so learning moment for, again, some of the academy students, but we were able to change all 100% of the locks in less than 48 hours, get that in and out. And luckily nobody was harmed or injured, and it was recorded with the police. But something definitely scary that happens, I'm sure, more often than not, but just something we didn't anticipate right off the bat going into managing the property in the first 2 months.
Is there any system that you're putting in place to, potentially head something off like that in the future?
Well, one thing we learned, the keys were, this is probably property management 101, but the keys from the previous property management company, they labeled them 1 for 1. So unit 1 had key number 1, unit 2 had key, and this is just basics. So that's the one thing that we asked them to do immediately, was just scramble. You should always scramble your keys so that anybody who takes the keys would need some sort of cheat sheet or grid to descramble them. We didn't have any, security cameras on site. So we're probably considering putting that up soon just to make sure we can capture whoever's, thinking about doing those types of things and add another layer of safety. But the neighborhood is in a really safe area, so there's no need for security patrol or anything like that. But we're making sure that we communicate with the residents if they see something, say something, so that it drives a little bit more assurance on site.
Awesome. All right. So it seems like this deal went really smooth for you, but I do have 2 kind of closing questions for you.
Sure.
Was there anything that was easy about this deal that ended up being hard? And was there something that you thought was going to be hard that actually ended up being pretty easy?
Something that was, let me think about this. I think the inspection was easier than I thought. So typically I'm like you, every single inspection prior to this property, there is always something that either goes wrong, plumbing or roofing or electrical, that just throws a wrench in your underwriting at some point. So I definitely have experience on every other deal. So the inspection, I would say, went a lot easier than I anticipated, which is always a good thing. Something that was more challenging. I would say in this scenario that the startup right off the bat was a little bit more challenging than I had hoped in terms of transition from the old property management to the new one. So ideally, in a perfect world, you get a seamless transition, everything runs smoothly, no delays. But unfortunately, on this property, we've had a little bit of delays in terms of systems, transfers, even resident rent collection still going back to the previous manager and following up on that. We do also have a handful of Section 8 residents that are staying here, and that process has been very slow to transition over. So that's been a little bit more challenging than I anticipated on this one in particular.
And is that just due to the time of the year that you're transitioning the property, or just, is it a new property manager? Do you have that kind of identified?
Now that, because we've worked with this property manager before, their specialty is typically units that are, 70 or below. But now that you mentioned that, I think because it was around the holidays, we closed on December 5th going into the holidays, I think that does play a big role in the delays and communication and getting things transferred with the city. I think that could be a big factor of that.
Hmm. Well, Jenny, thank you so much for sharing your knowledge and expertise with us here today. If listeners want to find out more about you and what you're doing, how can they reach out to you?
Sure, we're on all social media handles. Our website is also verticalstreetventures.com. I love talking about real estate, so if you have any questions I can help with or point you in the right direction, please reach out, and I'm happy to help.
Awesome. Well, Jenny, again, thank you for your time here today. We look forward to having you back to talk about your next deal.
Awesome. Thanks so much, Whitney.